welcome to my channel. Recently, I really want to learn how to do investment. So for the beginning, I decided to read a few investment books, and One Up on Wall Street is one of the most classic one. First of all, about the author. Peter Lynch is the author of One Up on Wall Street. He's a legendary American investor and have a legendary annual return of 29.2% when he was managing the Milligan Fund from 1977 to 1990. And he's a champion of the value investing method, which I will go into details in this video. The advantage of everyday investors like me. So, do we have an advantage over those professionals on the Wall Street? Peter Lynch tells us that yes. So, what are our advantages? First of all, for professionals who work on the Wall Street, their priority is not as much as possible, but to secure their job. They are bound to do some short-term decision to make their portfolio look good for the short term, even if it is going to hurt it for the long term. Secondly, they have regulations to follow. Different funds have different rules, but basically they may have to limit each holding of the stocks to a certain percentage, or they may not be able to choose certain stocks for the criteria of their fund. And most importantly, average people can leverage everyday observation and knowledge to identify promising companies. For example, I work in the tech industry, so I know more about Google and Meta more than professionals who work on the Wall Street and do not follow these companies closely. For example, I bought Nvidia in 2020 at about $60, and you know how it goes after. The category of stocks. So Peter Lynch has divided stocks into 6 categories: the slow grower, the stalwarts, the fast growers, the cynicals, the tenant ones, and the asset plays. So why does he bother? What are all these mysterious categories? The categories are actually tools to guide us on how to analyze the stock. First, the slow growers. These are large established companies with steady growth, but their growths are usually not too high, single digits, even like 1 to 2%. The good part of it is that they usually have very low risk, but of course low gain as well. Why would anybody want to invest in the slow growers? The only reason is the dividends. So that's also what the analysis of the stocks should focus on if you want to invest in them. The next category is the stalwarts. These are large companies with moderate growth. Moderate, I mean 10 to 15%. And the risk reward is low risk, medium gain. Visa, in my opinion, is an example of stalwart. You see it has an EPS of 15.9%, and its revenue is pretty smooth over time. There's no big surprise. You are not going to earn very much, but the income is stable. For stalwarts, you want to focus on the PE ratio, and you want to pay attention to its margins, especially for the most recent years, and of course the growth rate. The next category is the favorite for Peter Lynch and me. So this is the smaller companies that have a very rapid growth potential. The growth rate is larger than 20%, some may have like 40% or more. And with high gain, of course, they are higher risk. Well, did I just say smaller company? The funny thing is that nowadays, the companies with very high growth rates are also the company with very big market cap. So an example is Nvidia. It has a very insane growth rate right now, and it is not small. Another Magnificent Seven company that have a very high EPS growth rate is Meta, 37.9%, and its market cap is also very huge. For fast growers, the analysis should focus on the growth rate, whether in future it can keep up the growth rate as it is now or even better. The next category is the cyclicals. These are the companies that goes up and down because of the economic changes. So examples are the automakers, which does good in the good time and goes down in the bad time. For these kind of companies, it is best to know which part of cycles they are in, but it is not that easy. So it's good to check their inventory and see whether they have inventories that's hard to sell, which could be an indicator that they are in trouble. Next is the turnarounds. This is actually one of Lynch's favorite as well. It may be a surprise because these are the companies that are in big trouble and may even be in the edge of bankruptcy. But the good part is that once they turn around, their growth potential is pretty huge. So you are taking a big risk, but you also have a potential for a very high gain. The last category is the asset plays. These are the companies that have a hidden value in their assets, hidden behind their balance sheets. So if a company that have a gold mine that's sharply undervalued, that would be an asset place. But gold mine is not the only possible assets here. Other things can be the brand names, like Coca-Cola have a brand name. If it is not correctly recorded in the balance sheet, then it is an asset play. Now that we know the categories of companies, we can design a portfolio based on that. Lynch suggests a portfolio of 3 to 10 stocks. The reason is that if you have too many stocks, then you probably don't have enough time to follow all of them. And if you have only 1 or 2, it is hard to rotate between them for flexibility. So typically, Lynch will invest the majority in the fast growers, but he will also choose the stalwarts and some cyclicals. And the turnaround is also a very good choice if you know that they are going to turn around. And one important note is that companies do not belong to the categories always. They will change over time. A fast grower can become a stalwart, and then it may slowly become a slow grower or even a turnaround later. So remember to keep checking of their fundamentals. Lynch introduced some favorite attributes of promising stocks. Well, some of them I think they may be out of date. For example, he suggests to choose company with a very down or ridiculous name. The reason is that this company may be ignored by people, but nowadays you have screeners. You can actually choose stocks based on their fundamentals. People do not easily miss these kind of stocks, and some of them still hold true. I think, for example, spin-off may be a good thing for a company, and have a niche in the market is surely a good thing. And a company that is doing buyback of shares surely will do good for the stock price, even if it may be for the short term. Lynch also mentioned what to avoid when choosing a stock. So he really dislikes stocks in the hottest industry. Well, I think of the Magnificent Seven. I think he may be right in that they are too volatile, but whether they would be good for long term, I guess that still depends. And of course, some of the companies with exciting name may be mediocre companies, but I guess that's also something that's up to people's taste. But something really hold true is that companies that do diversification seldom do well. That's something that we need to be careful of when choosing stocks. Next, we will look at the key numbers and financial metrics that Lynch suggests us to pay attention to. So, if we are attracted to a company because of product that we really like, the next thing we should check is how much percentage does the product sales contribute to the company's overall revenue. For example, if I happen to really like the Apple's Vision Pro, and it only contributes to less than 1% of Apple sales, I probably should not choose Apple because of the Vision Pro. Next is everyone's favorite number, the PE ratio. So Lynch actually suggests a formula for us to check whether a stock is undervalued or overvalued. Growth rate plus dividend yield divided by the PE ratio. If the number is less than 1, then it is overvalued. A 1.5 is okay, and what we should really look for is over 2. An exception to the high PE ratio rule is the cash position. A company that have a very high cash flow can probably justify for a higher PE ratio. The debt factor is something that we need to be careful of. A healthy balance sheet typically have 75% of equity and 25% of debt. A lot of people like the dividends, but don't forget, if the company pays dividend to you, it doesn't have those money for the growth. So for a smaller company that want to grow fast, it is probably better for it to not pay dividend but reinvest in itself, Also, don't forget that dividends is something that you need to pay tax to. So compared to dividend, it may be better that the company do some share buybacks. And the book value is another thing that people need to be care of, because the book value is not always accurate as to the value of the company. Look for hidden assets of a company, and if you find it, this company probably is an asset place for you. For cash flow, we should focus on the free cash flow. The calculation of it is a little bit complicated, but we can find it easily on websites like Yahoo Finance. After you search the stock, go to the financials and cash flow, and you can find the free cash flow here. You should check that the cash flow is not going down significantly over the years. Another website you can check is the QuickFS. In there you can see the cash flow growth rate. A growing inventories may be a signal that the company is in trouble and is not able to sell as good as before. Be careful of the companies that have a pension plan, because they have to pay the pension even if the company goes bankrupt. So this makes it harder for this company to turn around in case they are in the edge of bankruptcy. Here are the final takeaways that I have. Don't try to time the market. This is the one most important takeaway I have. And invest for the long term for sure, because we are looking for value investment, categorize the stocks. That's something we have spent a long time about. Don't let price fluctuation dictate decisions. We should focus on the value. Avoid emotion attachment to the stocks. Don't decide because you have invested in the stock for a very long time. And focus on the winner, not the losers. So don't hesitate to sell the losers and keep the winners. Beat the market requires patience and an open mind. So that's everything I learned from One Up on Wall Street. This is one of my favorite books for investment. I hope that you have learned something from my video. If you like it, please click the like button and subscribe for more videos to come. Thank you.